Hello guys, after we know what is finance, so we go to learn about the types of finance. So firstly we search that what is types of finance, and we can see the lots of websites. In websites they have a lot of articles for types of finance, but we open the authentic. So we have come type of finance. There are mainly two types of finance: debit finance and equity finance. Second, the other types of finance are public finance, personal finance, corporate finance, and private finance. First, debit finance, basically the cash which you accrue to maintain or run your business, is known as debit finance. Debit finance does not provide ownership control to the money lender. The borrower must repay the principal amount along with the agreed upon interest rate. Mostly the interest rate is determined based on the loan amount, duration, the purpose for borrowing, the specific types of finance, and inflation rate. Debit finance can be classified into three types: short term, medium term, and long term. Short term refinance loans generally needed for a period of more than 1 to 180 days is called short term debit finance. These loans are borrowed for conveying the shortage of funds and temporary or occasional requirement. Short term finance is basically required for badly business activities such as paying wages to staffs or getting raw materials. The amount of getting a short-term loan is dependent mostly on other sources of income. For repaying the lines of credit from the business, suppliers are the most common forms of short-term debit finance. Mid-term debit finance and long-term debit finance then become equity finance. Equity finance is a classic way of raising capital for businesses by issues of or offering shares of the company. This is one of the major difference in equity finance from debit finance. The finance is generally applied for seed funding for startups and new businesses. Well-known companies apply this finance to raise additional capital for the expansion of the business. Equity finance is generally raised by issues or offering equity shares of the business. Basically, each share is an owner's unit for a specific company. For instance, if the company has offered 10,000 equity shares to public investors and investors buy 1,000 equity shares of that company, means he holds ownership in the company. Public finance. Public finance deals with the study of the state expenditure and income. It considers only the government finance. The scope of public finance includes the fund collection and its allocation among different sectors of state activities that are considered as essential functions or duties of the government. Public expenditure. Public expenditure means the expenses incurred by the government for its maintenance and for the welfare and preservation of the economy, society, and the nation. Public revenue. Broadly, public revenue include all the receipt and income in respective their nature and source which the government accrue during any given period. It will also include the loans raised by the government. Narrowly, it will include only the income from revenue sources, which include taxes, price, fees, penalties, fines, gifts, etc. And the third is public debt. Public debt means the loans raised is a source of public finance. carrying with it the repayment obligation to the individuals and the interest. But we have some important, the most important thing is private finance. Private finance donates an alternative method of corporate finance, helping a company raise funds to avoid monetary problems with limited time. Basically, this method help a company which is not listed on a securities exchange or is incapable to obtain finance on such markets. A private financial plan can also be suitable for a non-profit organization.